We're going to talk, as Gwyn said, a little bit about cash flow, running your business, and some of the things that I've seen over my time over here in Jersey and also before I came. One of the things I'm going to tell you is why you don't need to hire me. I'm a little bit pricey for a start, but principally that's because there's just a raft of tools out there, a range of different things, and if I press the right button this will go the right way, so it will, that you can use so that you don't need to pay for somebody else to do it for you. First of all, a little bit about me. I'm Mark. I've been in Jersey now for 12 years. I started at KPMG as an auditor, spent 4 years doing that, and since then I've been in our advisory team, advising people on a whole range of things. Mostly M&A work, so buying and selling businesses. I've done quite a lot of strategy work with businesses, helping them to either improve their performance or prepare them to sell their business, various things like that. And prior to coming to Jersey, I worked with a lot of very small businesses, preparing their accounts and doing the whole kind of package, from taking literally brown bag of receipts and some bank statements, turning that into a set of accounts, preparing the tax return, dealing with it, sort of everything, all the kind of accounting needs, full service type thing for small businesses. So I've seen a fair bit of the good things about businesses, how they run well, and also some of the bad things where they haven't gone quite so well. And we're going to go, I guess, how do you start a business? What do you need to think about there? Then we'll talk about cash flow, managing your cash flow and making sure your business survives broadly. And then, as I said earlier, the reasons why you don't need to hire me. The stuff that's out there that you can use so you don't need to spend a fortune on an accountant. So, startup, how do you get started? Well, one of the questions you're going to ask, and I think a lot of people ask, is, do I need a company? Should I have a limited company with a name, or should I just trade in my own right? Well, what's good about a company? A company, it gives you limited liability. What does that mean? It means if something goes wrong with your product and one of your customers wants to sue you, or indeed you incur any other kind of costs that you can't pay, your liability for those costs is limited to what the business can afford. You don't have to give them your house or your car or whatever else it is you've got. There are some caveats to that, particularly with investors, which we'll talk about later, who may well ask that you give what they call a personal guarantee. So in fact, they are still able to come and have your house, your car, whatever else it is you've got. But broadly, for your customers in particular, and your suppliers, they won't be able to take the house, which is always a good thing. What's the downside to a company? Well, do you really need one? There's a lot of paperwork, there's some effort involved, and there's some cost involved. So you have to pay an annual return fee, it's £150 a year. You're going to have to prepare a set of accounts. You can probably, with some help and advice, put together a set of accounts for a reasonably simple business without bothering too much about an accountant, but it will take time and effort. I would question whether your skills are best used doing that, given that you can do work in that time rather than preparing the paperwork. But there's that to do. There are various returns you have to fill in for the government and forms, but they're pretty simple. So I've got an annual return form here as a picture, which is that way. I don't know whether you consider that looks complicated or not, but frankly, there's about 4 boxes on there you have to fill in, which you'd be able to read off the bits of paper that come when you incorporate a company, write them down, and repeat every year until you go public. Then there's a couple of extra boxes to fill in. That's if you've got 30 or more people who own a bit of your company. So it's actually dead simple. And I would encourage people to have a look and have a stab before they go and talk to an accountant and say, oh, I've got all this paperwork, fill it in for me. Because it's not that hard. And some guys like Jersey Business will help you out as well. And they're free, which is the best price you can get. A couple of other boxes on there, and you have to sign it at the end to say it's true. I don't know how to go. That's whether you need a company or not. And I think it varies hugely according to how important limitation of liability is for you. And that depends on the product you're creating, How many people are involved in it? Is it just you? Or have you got a number of business partners? Things like that. And individual circumstances change. And that's probably something you do need to have a chat with somebody about who understands these kind of things. But just to understand what's required, not necessarily to go out and hire a load of expensive consultants. Once you've decided that, you're going to run your business. So what's important about running your business? Well, the most important thing is getting the cash in. Okay, now you've got to have a viable business idea, but I'm kind of assuming that you've got that far if you decided you're going to start a business in it. You've got to be able to generate some money. This business has got to feed you, it's got to house you, and then hopefully it's got to make a bit of profit itself so you can reinvest that and grow the business. And what that means is managing your cash flow. Cash flow is not the same thing as profit. You can make a very big profit and have no cash. I've seen it done many times, particularly if you've got businesses, not so much digital businesses, but businesses where you require a lot of assets. Because if you buy an asset, it doesn't hit your profit. You pay out a big check, you go and buy a big office down on the Esplanade. It costs you £1 million, and that doesn't hit your profit. That goes in what we call capital. So I make £500,000 of profit one year, but I've got this nice flash office on the Esplanade. Well, I've lost £1 million of cash. That's not a great idea. You've got to keep the cash coming in, and you've got to understand how much cash you need. So almost before you start, you should have an idea of what you can do in terms of how much you can sell. And then from there, you need to work out what are your expenses going to be, how quickly can you get the money in, and how much money you need to end up with. And you need to do that almost before you start. Certainly before you hand in your resignation letter and run off into the sunset to start this exciting new venture. If you can afford it, great. So you've got your cash flow. The other thing is, with cash flow, you've got to get paid. The difference between cash and profit is significant, as I've talked about. One of the things that creates profit, but not cash, is if you go and bill someone and they don't pay you. So as soon as you build them, in your accounts, you'll be showing some revenue, and hopefully, if you priced it right, you'll show a profit. But until you get paid, you've got no cash. And that, for me, is the single biggest reason I've seen businesses fail, is because they just don't put enough effort into getting paid once they've sent their invoice. So before I came to Jersey, as I said, I worked with a lot of small businesses, and one of them was owned by a guy named Tony. We won't use his surname. He was, by the time I met him, on his third company, and by the time I left after 3 years, he was on his fifth company. And he was a brilliant builder. He had work coming out of his ears. All the big contractors wanted to hire him. So he never stopped working. Problem with that was he never stopped working to collect the money that he was owed. And if you know much about the building trade, some of the main contractors, they can be, I think, being generous, a little bit cheeky. They will not pay you if it's humanly possible to do so. So actually you need to be banging on their door every day saying, where's the money, where's the money, where's the money? He wasn't doing that. So business after business after business, you think he'd have learned after the third time, maybe even the fourth time, just went bust. And they went bust because they just had no money to pay his own bills. He couldn't pay the builder's merchant for the materials. He couldn't pay the car hire people for the lease on his car. All of those things. And that's because he didn't collect the cash. And I think it's something people always feel a little bit kind of awkward about. You know, I do. I do my bills every month. I send them out. And if someone hasn't paid, there's a real temptation to go, yeah, but it's only been a couple of weeks, and you know, I know we said you were supposed to pay them, but yeah, I'll give them a week. I like them; they're nice people, and that's all very well if you've got big business that's turning over quickly, and actually you can take a view that maybe the relationship's a little bit more important than banging on their door. But if you've got a start-up business, a small business, that's one of your only customers, well, you've got to get paid. And I would say, well, yes, you might want to keep them on side, and you might want the wonderful prospect of lots of future business, but you're not going to be around to get that future business if you don't get paid. So that, to me, single most important thing, about managing your cash flow. When you've invoiced it, make sure you collect it based on the terms you've agreed. So, getting paid is a good idea, but what about the terms of that invoice? So you've decided to invoice people and you know you're going to collect your cash based on the terms of that invoice. What should the terms be? There's no one answer to that. I would suggest that it's a combination of what suits your cash flow and what suits the other party's cash flow, and you need to agree that between yourselves. I mean, that's particularly in a service business, that's kind of how it works. You're going to agree a contract which works for both of you. That's how you sell it. It's a bit different if you've got a business that does something tangible, because broadly, here's the thing that I'm going to sell you. Thank you very much. I'll pay you for it. And then there's pretty typical terms that you would find in the various industries. If you're making something that's reasonably unique, then it doesn't quite work like that, because there's no off-the-shelf thing and you can't go to 5 other people to buy it. So then it comes down to what you agree between you. What I would say is, when you're agreeing it, I would even discount the price a bit to get the money in faster. I've seen it done that people offer discounts for faster payment. That's not been terribly effective in my experience, because what people tend to do is not pay faster and then still take the discount. And that happens. You'd think, you know, people would feel bad about this, but no, that just happens all the time. So I wouldn't bother with that. I generally, if you can get away with it, you make the terms invoice payable on presentation, and I will invoice you weekly, if you can get away with it, every fortnight, monthly. But the sooner you can get the cash, the better, is the long and the short of that, really. We'll talk a little bit in a sec about investors. Before I do that, perhaps the other thing I should mention is tax planning. It's a thing a lot of people ask me about. A lot of small businesses ask me about it. Don't bother. It's really, everybody thinks, well, I'm starting a business, I've got to think about the tax and all this. What I would suggest is make some money first. Tax planning, in whatever shape or form, is generally quite expensive to have any real effect. So when you're making £1 million a year, come and talk to one of my tax colleagues, and we'd be more than happy to do something if it's possible so to do. But in Jersey, you've probably got a company, unless you're doing financial services, that's paying 0% anyway. If it's a small company, it's not going to be paying GST yet. So there's kind of not a lot of point in tax planning. But I thought I'd cover that because that's just a very, very common question we get. So, you're going to get your cash. Please, go on.
You're talking about on invoices.
Yes.
What is your view about having on there this invoice is overdue, then we'll charge you you pay an interest on that?
We do it. Nothing wrong with it. You'll struggle to enforce it. It's much the same as offering an early payment discount.
But do you ever, if people are late, do people actually pay that penalty? Do you charge them?
It's in our terms and conditions, I think, more because we want an avenue of recourse if it ends up going through legals. So we can say, if we actually end up having to make a claim against somebody, we can say, and we want our interest. To my knowledge, in a normal process whereby we give them an invoice and maybe they're a couple of weeks or a month late paying, we've never collected that. I would put it in, and I would put it in simply for that reason, so you can kind of protect yourself if it goes to court, and because you have to sort of demonstrate the kind of value of your claim. And if you're going to claim interest, if you can say, well, in my terms and conditions, this is the interest rate I'm going to use, then that gives you a little bit more, something a bit more concrete, I guess. You can pay anything you like in a contract, and if it's reasonable, then it's enforceable. So, talk a bit then, I guess, you get your cash from your customers, but where else do you get your cash? It comes from investors. Now, there are all kinds of investors. There are just what we call angel investors. There's a group over here called investors, which gets together people with a bit of cash that they want to invest in something, I guess, a bit different, sort of smaller businesses, startups, or just something that does something a bit out of the ordinary. You can get money from them. You can get money from the peer-to-peer lenders. They obviously it's a peer-to-peer effort, so you've got some people who have some money to invest, you've got some people who want to borrow some money, and they kind of bring them together and take a bit of commission in the middle. Or you can just go to the bank. Two kinds of investment broadly. You're going to get an equity investment, so they'll take a piece of the company and give you some money for that. And then that's the kind of thing where you don't have to pay it back over a set period or anything. They simply get a return on their investment. One of the things I would say about that is if you're going to do it, get legal advice and put in place a shareholders agreement, which is a contract between you and the other shareholder, which says how it's all going to work. It says how it's all going to work when the money goes in. It says how it's all going to work as you run the business, and it says how it's all going to work when you sell it afterwards. I have seen so many companies who have brought in another shareholder over a period of time. Then they come to kind of go their separate ways. Maybe one of them wants to retire, and they spend the next 5 years bickering, destroying the value of the business, going in and out of court, trying to work out how to get the one guy out. And we're not just talking 2, 3, 10-man businesses here. I have been doing some work recently for a business which employs over 100 staff. They've got, I think, about 15 shareholders at the last count. But the problem they've got is 2 of them that own about 45% of the business between them want to retire. All well and good. But then they had a shareholders agreement, they just hadn't updated it for about 15 years. So they're sitting there now going, well, that agreement's no good. You know, that price is ridiculous. I'm not retiring at that price. And you've got the rest of the board going, well, that's all very well, but we can't really afford to buy your shares. What are we going to do now? Well, that's been running about 2.5 years now. We've been talking to them on and off. So they've spent a few quid with us for a start. I mean, we're not going to destroy the value of that size of business with the money they've spent with us, but if they do end up going to court over it, particularly because there are lawyers involved in the business, it's going to be expensive, messy, and very much less than ideal. So if you get outside investors, even if you just go into business with a partner, get an agreement up front, get it properly written down, and I would say that's one of the things I would spend money on. I would go to a lawyer, get somebody to look at it properly, and make sure you understand exactly what both of you are doing, and both of you understand the same thing, because that's always another classic in agreements. One person thinks it says this, the other person thinks it says that, and then they come to kind of do something around the agreement, and they're kind of going, well, no, I thought it worked like that. No, it definitely works like this. And then you just get back into the same old cycle. So if you get an equity investor, get a proper agreement, and make sure you get a sort of reasonable value for that bit of business that you're selling. The other option is borrowing money, whether that be from a peer-to-peer lender or a bank. What I would say is, if your business is broadly not a lot more than an idea, that's the time for an equity type investment. Firstly, because no one's going to lend to you, and secondly, because if they do lend to you, you're probably not going to be able to pay it back. So when you've got some revenue, then you talk to a bank or to a lender, when you've got something you can show them. That being said, when you start your business, it's likely that you're going to open up a business bank account. And if you were thinking, no, I'll just run it out of my current account, please don't. It can make a real mess of things when people start mixing their own money with their business money. You've got to know what you're taking out of that business to feed yourself, pay the mortgage, etc. And you've got to know what money your business is making. I see this with big businesses. There's a job we did for a bank, and they'd lent some money to a fellow over in Guernsey, as it happens, who was running a business. I can't say too much about it because there's very few of what he does. But the business, he wasn't paying the interest on his loans. He was breaching all kinds of covenants that are around the loans, and he'd just spent 80 grand on a Porsche. So the bank had kind of, this being obviously the Channel Islands, you notice if one of the guys you're lending money to has just bought a Porsche, because you probably see him on a Sunday morning in a car park somewhere. And what the guy was doing was, the business was reasonably profitable. It was making some money, but he was paying himself £250,000 a year, and then bought himself a car, not out of that £250,000 he was paying himself. No, he just bought that out of the business money anyway. And he had no concept of the separation of the business's money and his money. And in that instance, we're talking a limited company as well. So understandably, the bank got quite upset about this, and they quite strongly suggested that he hire, well, us as it turned out, but an accountant to go in and kind of sort this mess out and kind of delineate the separation between the two and where the money had gone, and then impose some quite strict terms on what he could pay himself, what he could effectively take out. And I think they ultimately allowed him to take out something like $30,000 a year, because otherwise they'd have had to take his house because he couldn't pay his mortgage. But if they could have got away with less than that, they'd have said less than that. So that's quite a pay cut. And that's broadly because he didn't separate the business's money from his own money. So you need to do that. Anyway, that was a slight digression. We were talking about opening a bank account. When you open a business bank account, then is a good time to talk to the bank if you think you might need some money down the line once you've started generating revenue. So if you think you want to borrow, have a chat with them. Go, when you open the account, ask if you can go and see one of their business advisors as well, and just say, you know, I've got this, well, idea at this stage. However, I'm hoping this is going to turn into quite a nice business. And once it's turned into that nice business, I might need to borrow some money down the line. I was talking to a friend of mine who works over here and does lending to small businesses. And he said, the worst thing in the world you can do is say, well, I got my redundancy check, I started a business, I've spent all that money, now I'd like some of yours, please. Which people apparently do quite frequently. The answer is going to be no. You need a plan. You need to set out your cash flows, set out what your profit's going to be. You need to forecast it for 3 years, at least. Probably not more than 3 years, because things change so fast it's actually not going to be worth the paper it's printed on for years 4 and 5. But you need, if you come with a plan and some detailed numbers, realistic numbers, and you can explain why you need the money, that's step one. You can't explain why you need the money, you can't predict when you're going to need it, and most importantly, if you can't show how you intend to pay it back, no one's going to lend you any money. Once you've got that, you need a convincing story. You need to be able to explain why you're going to need the money, what you're going to use it for, how it's going to help you. One of the things he also said when I was talking to him yesterday was when he worked back in the UK, 4 people come to him, he would end up lending maybe to one of them, because 3 of them had no plan whatsoever. They just had this vague idea that we might need a bit of cash, please, and we're not really sure how much it is, but how much can I get? We sort of chatted about it and described they're trying to save you from yourselves if you come for that kind of loan, because, as I said earlier, it's not just about the assets of the business. If it's a business with not too many assets, they're going to want a personal guarantee, which means it will be your personal assets as well. So before you put that on the line, they, as a responsible lender, as they're now called, don't want to give you money you're not going to be able to pay back, because it's not good for them, it's not good for you. They don't want to end up owning a flat in St Helier and a random car. They want their money back. So you've got to be careful when you borrow money, you've got to come with a plan. That being said, if you do want to get money and you go for a business loan and you get turned down, he said it's remarkable how many people then walk around the corner to the other bit of the bank and get a personal loan. But that's even more risky. There's a reason they won't give you a business loan. And I would, if you've been turned down for a business loan, advise fairly strongly against then going out and taking a personal loan, because you've been turned down for that one because they don't think you can pay it back. You get a personal loan, great, but that one puts even more risk on you losing your assets. Okay, so that's cash flow management. A few things just to sort of think about and watch out for there. The last thing I was going to talk about, well, 2 things. One is selling your business, which I'll come on to in a bit. And the other thing is what tools are out there to manage your cash flow, to manage your business more generally. There's loads of stuff, and it's all really quite cheap. I think the most popular small business accounting package at the moment is a thing called Xero, which works very well. It's sort of cloud-based, and you can set up, if you do end up hiring an accountant, my friend in the UK loves this, he's a small business accountant, has I think, probably doubled his number of clients, simply because you can set up a direct link between Xero and your accountant. You can share it with them, and it almost gets halfway to preparing the accounts for you. So it's fantastic for him. It's fantastic for the businesses that he works for, because they just enter their various transactions, and it takes a lot of them just straight out your online banking, and then that produces the accounts without all the hassle and the paperwork and the effort that used to happen. So that's a very good one. There are others available. QuickBooks is also quite popular. That takes a bit more manual effort, but is getting closer to the Xero model as they kind of update it. They both work, but actually there's not a lot wrong with just a spreadsheet. Takes a bit more personal effort, I suppose, a bit less intuitive, but it's dead easy. You just write down what you've spent and what you spent it on, and write down the money that's coming in as well. And it's not difficult, and there's help out there for free. So I've seen people running £2 million turnover businesses on a spreadsheet. Happens quite a lot. We get a bit nervous when people do that, or that kind of turnover, but it does happen. It happens frequently. I've gone out and bought businesses that run it off a spreadsheet. Little word of warning though, if you're at that level of turnover. We looked at a business this year for one of my clients, looked at buying it, and they were doing it on a spreadsheet, but they weren't doing it very well. So they looked like they were making £100,000 a year profit when we first looked at the business. Then we sort of started asking a few questions, which is broadly what we do when we're buying a business for a client. It's like a kind of house survey type effort. You go, well, and the foundation's solid, that kind of thing. So we had a look, and they said, oh yeah, no, these aren't quite right. Here's a new set of numbers. Right. That's when the alarm bells start ringing. You haven't got the numbers right first time, I'm concerned. So we had a look at those, asked a few more questions, and they go, oh yeah, they're not right either. So we said, right, we're going to come back in a couple of months. You take that time to sort out your numbers. During that time, they doubled their turnover, and they got their numbers right. They were making a loss. They hadn't got a clue how much the business was costing them to do. I mean, these guys were great at selling. They doubled their turnover in like 18 months. Yeah, brilliant, going out there. But the thing is, they were getting loads of business because they weren't pricing it right. They were selling it too cheap, and they didn't understand their own costs because, well, they were running too big a business off a spreadsheet, frankly. But fine for small businesses, or use QuickBooks, Xero, any number of packages out there. Get the help of free resources like guys at Jersey Business and things like that. And use those first before you start paying for stuff. Come and pay for stuff when you've got more complicated needs, when you've got something where you really need that certainty and that protection, and quite frankly, where you need, if something goes wrong, to have somebody who's going to kind of stand behind it and say, yes, we gave that advice and we'll help you put things right. That's when you pay for somebody. So that's broadly what I had to say, apart from the last bit down the line, the bit that I'm most interested in, I guess it's what I'm involved in most of my work day to day, is selling your business. Selling your business, question really is going to be, what's it worth? Well, I can't tell you the answer to that. You come and hire me when you want to sell it. We'll have a look at that and we'll work something out. But actually, this comes back to the earlier point. What's your business worth? It's worth a multiple of the cash flows it's going to generate in the future. That's what people are buying when they buy a business. So actually, whether you're running your business or selling your business, if you get your cash flow right, that's half the battle. So that's broadly it. If anyone's got any questions, I would be delighted to try and answer them with no guarantees. Hello.
Just interested, you say it's worth multiples of your cash flow, not multiples of your profit.
That's right. So what we do when we value a business typically is we use a multiple of what we call EBITDA, which is earnings before interest, tax, depreciation and amortization. That's what the textbook says, and that's what we do in practice. But EBITDA is a proxy for cash flow. Comes back to the point that actually a business can be profitable without generating a lot of cash, and ultimately you buy an asset to give you a return, and that return is what cash can the business pay out. And so while people talk about profit multiples, profit or adjusted profit, EBITDA, is just a proxy for cash flow. Anything else?
It might be slightly off scope, but in terms of the problems of starting a business, one of the issues I have, it's kind of difficult to find time to work on it to the degree that you need to at the start, balancing up against having income. So I mean, on the one hand, you could maybe get a loan or something or find investors, and then that would give you the time and the space to get something off the ground. But then on the other hand, that's quite difficult without really having anything to sell. So I mean, okay, it's out of scope, but would you have any words of advice to people who are kind of, I don't know, working full-time and trying to start businesses on the side? Or
It is difficult.
Yeah.
I would probably advise against trying to get a loan until you're generating revenue.
Yeah.
Certainly you're going to have to put a bit of your own money in, whether that means saving up to take a sabbatical from work, if that's what it needs. I mean, if you genuinely can't do it in your spare time, then maybe you need to arrange some way to take a bit of time off work without taking that big plunge and handing in the resignation letter and running off to go and do it, because obviously you do need to eat and pay the mortgage.
Really, because I mean, you can do a certain amount part-time and on weekends and so
Yeah.
on. But the thing is that you're always working at a snail's pace. You realise that months and the years have gone by and you've done a little bit more of it.
Mm-hmm.
But then always in your mind, there's, okay, if I'd worked on it full-time or half full-time, I could have done this. I maybe need to do this, and in practice I've already done that. So it's always like you're running.
And I guess, yeah, that's probably a particularly acute problem in the digital business,
Yeah.
because things are changing so fast.
Right.
But I mean, the only suggestion I can really offer is if you can arrange something like a sabbatical from work to do it. I really wouldn't borrow a load of money and then stop working, because that almost compounds the problem. You've not got a job and you owe a load of money.
Yeah.
So yeah, I think if you can arrange a sabbatical, great. And a lot of people are doing that these days. Just given a couple of our staff 6 months off starting in January. Not to develop a business, actually. They're just going to go and swan around Asia for a bit. But
We see that in terms of business,
Yeah.
where people will try and either reduce their hours at work or take a block of time off.
Yeah.
And that seems to be the easiest way to make that transition. There is a tipping point, at which actually you can sort of take the gamble of managed gamble of leaving work, but if you can manage it to that point, then
I can see that kind of makes sense, really. I mean, also if you're prudent, you can kind of save up a bit.
Yeah.
I mean, like you're saying, so if you have to put some of your own money in it, and that's possibly one mistake I've made, because with the things like freelancer, you can pay maybe not even very much money, maybe even a few hundred or a few thousand quid to get lots of stuff done, that would then maybe save a bit of time. So yeah, that's.
I think. Sorry, go on.
Also nowadays, it'd be kind of things like Fiverr and all these different online services you can get, where you can pay freelancers a good, a small amount of money. You should make sure you're utilising all of those, because there's jobs that can be done which you can pay people in the online community to do for you.
Okay, yeah.
Which aren't as expensive as you think they might be.
Yeah. I think the only danger with that, I mean, it might be that you would spend as long kind of organising someone to help you and then checking they've done it how you wanted it as you would have done if you'd done it yourself.
It depends what the job is, isn't it?
Yeah.
I think the other point I was going to make is you're talking about whether you put your own money in. Well, if you're not going to put your own money in, then what do you expect an investor or a lender to do?
No, that's a good point,
you need to demonstrate commitment to your own idea before you can ask other people to commit to it, I think.
I think one of the toughest things for small businesses or people starting out businesses is that thing you said about getting the cash in. But
Yes.
people seem a bit embarrassed to ask for money.
They do, yeah. I mean, as I said.
Is there any advice you'd give people to sort of force them to sort of, look, you've got to start going out there and actually asking for this cash when you invoice people?
I wouldn't go in and bang the door down straight away, and you'll be surprised actually how reasonable most people are if you ask and explain the situation. Not everybody, as I said, particularly main building contractors can be a little bit cheeky, but well, it's easy to say, and just don't be embarrassed to ask, but you've got to ask. If your business is going to work, you've got to get paid. So I would guess if that's a serious problem for you, maybe you can get someone else to do it on your behalf, but someone's got to do it. It actually works quite well if you get a mate or hire somebody or whatever it is, and you have one of them be the kind of credit controller. So they phone up and go, "Now, can you pay me? You know, I really need the money. I'm the credit guy. It's my job." And then that doesn't damage the relationship you have with the customer, because they can phone up and go, "Oh, your credit control's a real pain, isn't it?" And you go, "Oh, yeah, sorry about that, but I really do need the cash." And then it just kind of, you tag team, and that works quite well. I mean, it's not for that reason that we do that, but we have a finance team, who do the chasing on our bills. We do it for efficiency. Obviously, there's lots and lots of bills out there. You know, we've got 120 people in the office, and so we need that, because otherwise we'd spend all our time doing it. But it does still work quite well, because they can be the kind of bad guy, the bad cop, and we don't damage our relationship with our clients, but we still get paid. But you've got to get paid. It's so important.
On answering that as well, when I was running my business, it was the worst. I hated talking about cash. In fact, I hated talking about cash, even in terms of actually working out how much I was going to get paid. But what I found was that I would leave it until the bill was about to be due, and I'd always phone, because then you're not actually having to look at somebody, and you sort of got a little bit of separation there, which helped. And I would phone and say, "You're due to pay me next month or next week, just got to check that that's coming in." And then when it didn't come in, or if it didn't come in, I would phone the week after to say, "You said you were going to pay on time and you haven't done." So actually I would make it their problem, not my problem.
Yeah.
If it's something you're selling monthly, direct debits are always nice.
Yeah, absolutely right. Or upfront payments, deposits, etc.
Yeah.
You can ask them. You will get them. I'm working with a very small business in terms of my home, and they said to me, "Look, can you pay half price, half the money down?" I did. I was quite happy. So you can ask for that, and also the timing of the billing. Once the job's complete, sending that final bill for the full amount immediately, and that can be done by Xero Online or all these kind of different processes now. You can virtually leave someone's home and send them bill as you get into your car. Don't wait and leave it for another 2 or 3 weeks before you send them, and then you start getting anxious with the person that you're looking for the payment for, all because you were delaying the payment and what's going out in the first place.
And I mean, we're as guilty of it as the next business, but there's no set date on which you have to raise a bill. If you finish your work on the 5th of July, you don't have to wait till the 31st before you send the bill.
Also, for some people, mobile payments, you can actually, you can be at your home now. I can say, "Look, you finished the job, you're happy, it's whatever, let's pay now on the card."
Yeah.
That sort of thing with PayPal systems, whatever, can happen immediately. So you don't need to be embarrassed because you've done good work for that customer.
Your other option as well in the digital industry, if you're on a monthly retainer with the client, there's no reason that bill has to be raised at the end of the month. A lot of people are raising it at the start, and that's helping their cash flow.
Yeah. Anything you can do to get money in faster is a good idea.
But most people are reasonable people. The majority of people will say, "Look, I've had the work done, I'm happy to pay." It's only a few that you're always going to have difficulty with. And actually, if you have real difficulty with them and they won't pay you, go to various sort of credit agency, recovery agencies, they'll give you money back. You're better off paying a fee and getting them to put pressure. But it's very difficult for you to be the face of the business and have arguments with the client, because it's not going to go anywhere.
No.
About the letters sending the threats suggesting that the next day to pay debts is enough. Just a little bit extra encouragement and not.
Yep.
One of the things that we find tricky with some of the people that we see, particularly in the digital sector, is to model the cash flow.
Yeah.
Because that can be quite tricky to know, well, how much are you going to get in? It's a sort of it can sometimes be a backwards way of looking at, well, not so much how much do you think you're getting, but how much do you need to get in, and is that realistic? So
it's knowing sort of how much to charge in the first place, I guess, isn't it? And
there doesn't seem to be a sort of, I don't know, model for an app company or this, that or the other. It would be quite nice to have, some kind of sort of, this is what an ideal cash flow for us.
There's an interesting paper. It doesn't quite work at the small business level, but I saw it the other day, which talked about valuing some of the larger digital businesses. And normally with a business, you would start with what the sort of current sales were and kind of project that forward. What they were talking about is starting with the size of the market itself. So what is the market you're selling into? How big is that? And then thinking, well, of that market, how much of it can I realistically capture? It was an example based around valuing Yelp, the kind of classified ad type business. They say, well, this is how much advertising spend people have. This is how much of it they spend on this kind of advertising, and this is how many territories of that market I'm in. So this is roughly what I can expect my market share to be, and therefore that's how I'm going to project my cash flow. So it's starting from sort of macro and coming into micro, which is the opposite way to the value normal businesses, and where you start from their fundamentals and build up. But that's something that you might be able to consider.
We've done that quite a few times now, where you're looking at the size of the market by country,
Yep.
the number of users, the number of downloads, and then you kind of say it's actually a test for the individual, because sometimes you're saying to them, do you really think you're going to get 10% of all downloads in the UK?
Yeah.
Yeah, actually it's going to be 0.00 or whatever. And actually it's that way that drives your kind of revenue.
And I suppose, the question becomes, is 0.1% of those downloads viable for your business?
Yeah. Right. The only challenge across that is the timing of the income stream. Is it going to be a consistent line?
Yeah.
Or is it going to be whatever? And that's where with traditional businesses, if it's clothing, there's a seasonality about it, or Christmas to be good. With app downloads, it can be very high, and then it can just die. But that's a challenge you face.
Yeah, it is. I think ultimately, if you've got a viable product that you believe in, then you should try it and see. But being a prudent accountant as I am, you should probably not risk too much capital if you're not very certain about it. Okay.
Thank you very much, Mark.
No, thank you for listening.